Welcome to Focus on Fuels, brought to you by StoneX. Your hosts are Trevor McClanahan, Risk Manager, and Alex Hodes, Director of Market Strategy from the StoneX Energy Desk. Alex and Trevor help fleet managers, fuel buyers, and energy procurement specialists gain control of fuel costs, boost margins, and keep their businesses competitive. Join them for another deep dive into the volatile energy markets.
Remember that the trading of derivatives such as futures, options, and over-the-counter products or swaps may not be suitable for all investors. Derivatives trading involves substantial risk of loss. Past results are not necessarily indicative of future results.
Hey everybody, welcome back to Focus on Fuels. I'm your host, Alex Hodes, and I'm here with Trevor McClanahan. How's it going?
Pretty good. Been a bloody week in oil. So, we're all, I don't know, everybody's thinking that it could continue to go down below where we are now. We're sitting right at $60 a barrel on WTI and got there pretty quick. Last time we were on, we were talking, it was kind of rallying at the time and unexpectedly. So I think it kind of did what we ultimately expected. I think I at least thought it would take longer than it has to get to this level. But we've had 4 days straight. Today we're talking on October 2nd. And we've seen 4 straight days of sell-offs in WTI, Brent, and the whole complex essentially. So, we're flirting with the upper 50s on WTI now.
Yeah, I think the market's kind of been everybody has been talking about an expected surplus and kind of this bearishness in the market, but we've seen some jolts of life in September, whether that's to do with regional demand, just seasonal demand, anything like that. We're now kind of shifting towards kind of refinery maintenance season around the world in certain areas. And so that might kind of take a hit on the market as, less crude's going to be input there. We're starting to see, as of the last week in the EIA inventory, we saw refinery utilization rates finally start to come down a little bit. And one factor that's kind of been a supporting factor here for crude oil has been Chinese buying. So they have been kind of strategically buying at these lower points in prices. We've seen them kind of step into the market and fulfill more of their strategic petroleum reserves with that crude oil. And it has not ran through their refineries quite yet. So right now they're kind of shifting and drawing down some of those barrels and running them through their refineries. This upcoming next week, I believe, is the Golden Week in China. So we're going to see some holiday effects there in China as well. So the initial anticipation for this is that we're going to see a dip in Chinese buying in October. And so you're starting to see a little bit of weakness in crude oil in East Asia right now.
Yeah, and I think, layering on top of that weakness, just on the demand side, just a lot of refinery issues globally. Obviously we've touched on the Russian refinery problems that they're seeing. We'll go into a little bit of depth on that today. But Europe is going through a refinery turnaround maintenance season, just similar kind of what we see and what we've talked about domestically here. We didn't have a major refinery turnaround season domestically. However, Europe is seeing a pretty substantial turnaround. So I'll go ahead and dive into that. So what we've seen from September, and this refinery turnaround season in Europe is going to last all the way through the middle of November, and there will be some extended refinery turnarounds going through the end of the year. But that's going to take off 853,000 barrels per day of refinery capacity in Europe. They hold about 12.2 in capacity at total. So that takes off, roughly 7 to 8% of their capacity for that period of time. So that's going to make them look to the export market or import market on their side. And we might see an uptick from U.S. Exports on the diesel side, especially. Remember, for the U.S. listeners, Europe uses a lot more diesel than they do gasoline. So keep that in mind, and they're going to have a little bit more demand for that in general. So that on top of Europe or Russia slowing down their refiner exports is going to really cause a pinch in Europe, and they're going to be looking to markets like the U.S. To fulfill that void. You want to talk about the Dangote refinery as well?
Yeah, so in another refinery in the Atlantic Basin, so that is, the East Coast, the Northwest Europe, and Africa as well. So the Dangote refinery has been under construction, and kind of been actually functioning at a full capacity earlier on in this year. And that was supposed to put quite a bit of pressure on refined products. But recently, we've seen crude oil shipments to Nigeria slow down to some of their lowest points in several months. So they've been experiencing some issues here, and that could prevent. They've been a big exporter of gasoline as well now. So we've seen kind of a shortage in products coming from there, and that's just putting a little bit more pinch on the refined product side of things. That, and to go along with what Trevor said, those refineries that are going offline in Europe will also kind of tighten those supplies. So this time of year, though, we do see kind of seasonal strength, and most of it has to do with kind of a combination of we're starting to enter that period where there was the harvest season, and then we're also going to kind of turn into heating demand season as well. But in addition to that, we're kind of seeing that turnaround season as well. So it's kind of a pinch in supply and slight upticks in demand, and that's when you start to see kind of more basis levels going higher, and prices in the refined products, specifically on the diesel front, start to move higher. So we're still seeing kind of some strength on diesel. Crack spreads had kind of taken the lead, and that had been kind of pulling up the rest of the complex of crude oil. But with this is kind of the expectation and where we are at now, moving forward. So any kind of changes in whether Dangote gets up and running a little bit more than expected, that could put some downward pressure. But overall, the U.S. Has started, they've actually rebuilt diesel inventory substantially. So that's kind of helped a little bit in the U.S. of how high diesel prices could go. So, we've seen in years past, and honestly, earlier this year, we were at extremely tight inventory levels. So we've seen them be able to rebuild these inventories at a pretty rapid pace this year. So heading into the winter, we're now at the deficit is kind of at its smallest level since April. So things are looking a little bit more comfortable on the diesel side of things, but that's not to say we're not going to see some upticks in price in diesel in the very near term.
Yeah, especially, I mean, we're, like you said, we're heading into the winter where we see a little bit more demand for that for diesel in general, and we got to keep. Unfortunately, we have to continue to talk about these Russian refinery issues that they're having. So, just want to throw some statistics out there for us. Diesel exports as of September 2024 and just across the board in 2024 averaged around 807,000 barrels per day out of Russia, diesel exports, that is. And we've heard about gasoline exports being banned out of Russia. That didn't make up much, though, right? There wasn't a lot of exports coming from Russia on the gasoline side, but they've also partially banned diesel exports out of Russia as well. So that has dropped about 85% of the exports coming out of Russia and just globally. So they've dropped down to 325,000 barrels per day. all the way up to August, and we've seen them even trim even more as of this fall. So again, that's just kind of compounding on itself. And then when you add the fact that Europe is going through a maintenance season on top of that, Dangote is having issues as well. That's going to, I mean, logically, there's going to be more of an export appetite for the U.S. So, we could see inventory start to draw down. Last winter, I just want to remind everybody that we've seen a really tight pinch right towards the end of the winter in the Atlantic Basin, like you mentioned it before, and it created a very the term structure on diesel was very inverted. The curve itself just became extremely inverted. I could see something like that happen again if we have a big winter event where there's a bigger demand cycle for heating oil, and it could just create another atmosphere that we've seen towards the end of the winter last year. Obviously, inventories have recovered domestically, but we could see that could unfold pretty quickly considering the global picture right now.
And I think that's also a good point because last year it was almost like we thought it was kind of over in the winter.
Yep.
And then we kind of got those last blasts of cold, and that really hits the East Coast. So the East Coast is where the NYMEX heating oil contract is delivered. So seeing any kind of strength in those inventories in Pad 1 on the Atlantic coast, that's where you start to see that tightening affect heating oil prices. So a lot of those East Coast cities and areas still use primarily heating oil as a fuel. So it's kind of a different part of the year where you see that become kind of the driving force behind oil markets, diesel markets specifically. So outside of there, if you're in the Midwest or West Coast or something like that, your primary source of demand is just diesel fuel for like trucks.
Sure.
And agriculture, which slows down in the winter. So that's why you see kind of regional differences at this time of year. But I think looking at just the NYMEX heating oil price itself, that is a time of the year that you could see kind of flipping back, kind of more backwardation in the market. So we've flattened actually quite a bit, which is, in my opinion, kind of interesting because we're seeing such a strength in the crack spreads, but yet we're not seeing as heavy of strength in the prompt spreads of diesel.
Sure.
So it's kind of been at odds with each other to some degree. So one way you could take away is that diesel, with regards to the actual underlying crude, that's kind of showing some weakness on crude, but diesel is still kind of being demanded, and that it's still worth value of you converting that crude into that diesel. So, and that's to do with a lot of kind of these more OPEC barrels coming online as well. So up ahead, we're expecting more crude oil supplies to even be kind of the market to be flush with crude oil. So, and one other factor that I think might be kind of a help cap some of the strength in diesel will be the fact that these barrels that are coming online are going to be of Middle East origin, which tend to have a heavier amount of, or kind of will be able to be used and obtain more distillates from these grades of crude. So it's going to be kind of a more distillate rich grade of crude that's coming online. So it's kind of it's a very interesting market because I think there's a lot of factors that are almost at odds with each other. And I think that explains a lot of kind of the sideways price action we've been seeing, but it's hard to kind of be outright bearish on heating oil when you see all that refinery maintenance and the ongoing issues in Russia. But is that already being baked into the market? Are those barrels that aren't making it to the market from Russia, is that already kind of taken into account? Or is it something that's going to kind of unfold in the rest of October?
Yeah, I mean, for me, the way I look at this, we've kind of beat this one home in the last couple episodes in general. But I think it's pretty obvious that we're bearish crude, right? And I mean that the problem is no longer whether or not we'll have enough crude oil globally, but the bigger problem is the refinery capacity is just simply not growing, and we've seen IEA under. We've talked about that. They've under. They've
Estimated for their demand.
Yep,
For
time after
years.
time.
Yeah.
Right, and the refinery capacity is not increasing anymore. We've seen a big increase year over year. What was it, 23 with Dingote coming online,
Mm-hmm.
and then also Houston.
I was going to say earlier of this year, but then we've seen some closures that's kind of
taking
countered that.
Right, exactly. Going the opposite way now. And there's a lot of, I mean, that just makes sense from just kind of the last 5 or 6 years. There's just been a lot of, nobody wants to put investment towards refineries because of this EV shift, right? And this, but the reality is the demand for these products are still there, and they're growing despite all the estimates. So the investment's not necessarily there on the refinery side, and I think that's the biggest point that we want to put a spotlight on.
And I think that might be honestly kind of a west versus east thing, because we are seeing a little bit more of the refining capacity being brought online in Asia or the Middle East. But yeah, we're not seeing any new refineries come online in Northwest Europe or the U.S. Yeah. In fact, we've seen them move the opposite way. So yeah, that's kind of one of those things where, and perhaps that has to do with kind of the demand characteristics of those economies as well too. So yeah, the more advanced economies with regards to energy usage, like the U.S. and Europe, are kind of shifting towards EVs, maybe closer towards more LNG use, stuff like that. But to be honest, I mean, we haven't really seen too big of a dip on the diesel front with regards to demand in the U.S.
No, not at all. And I mean, I think that just what I really wanted to highlight is the fact that it creates a more sensitive market, right? If there's anything that does go wrong, there's not that, firefighter. We can't hose that off and just pour more diesel into the market like we were able to in years past. So we're running these refineries really hot, and it's just going to be hard to fill the voids if anything does go wrong and anything breaks. These are old refineries. There's not a ton of investment in them. And if something goes wrong, it can make that price go, especially the prompt month, really rapidly spike pretty fast. And, in any kind of weather event, a quarter like we've seen last year, it could really make that market more sensitive and spike the market more. But what that allows is, if you are considering locking your diesel in for any period of time, that those deferred months, the further out months, will be cheaper, and it'll be more attractive for the buyers to come out and hedge their diesel if they have an appetite for something like that. So we haven't had a lot of interest here recently. Most of that is to do with the fact that people are still finishing up projects heading into the winter. Ag-related stuff, obviously, still in the middle of harvest right now. But if they back into this winter or this fall, and heading into the winter, if crude does get in that 50 range, mid 50 range especially, and diesel is relatively calm at the time, we're not seeing any kind of weather-related events or some sort of major outages that are going on. I think that's a good time to buy, and I think that that target would be for, like, again, if crude is at mid 50s, and anybody that's looking for some more analysis around that and just advisory services, we're happy to schedule calls with anybody on that. So just feel free to reach out to us on that. And Alex and I can at least point you in the right direction of somebody. We have a huge fuel distributor network of our customers that we can at least point you in the direction of. And then some end users that are relatively large, we can do the hedging services for them themselves. So always here for that help if needed. So just wanted to point that out. Also, Alex, you want to talk a little bit about OPEC? We got another meeting this weekend, but I know there are a lot of rumors swirling about how much they're going to bring back online this weekend. What is your read on this?
So yeah, I think the original thought was that they're going to bring that 167,000 barrels per day, month by month. But then I believe there was some report by OPEC that kind of stated that that was kind of an assumption by some market participants. But that could be just OPEC kind of trying to paint the narrative that they want to paint. So I don't foresee them, slamming the market with more crude than that. But that's just pure speculation from my point.
Yeah.
I think the kind of going as they had been planning would be consistent with their moves prior, in that they are kind of comfortable in this price range. But again, kind of what you were saying is if crude oil does reach those 50s, 55s, potentially that's the time when we would see maybe OPEC make an adjustment to their supply increases, or the U.S. shale response would kind of come in. We'd see production kind of reduce. But according to the recently released EIA production report, and we also released our crude oil production report that kind of analyzes the month to month production levels. The U.S. still hasn't really shown. There was a few months of just steady, flat growth, but from June to July, we saw an uptick, and that trend's kind of still been there. And then even over the past month, we've started to see finally a bottoming out of rigs. So it seems, even though this price point, we've said kind of like that $65 area is kind of where the floor is. It seems that the shale producers are able to still be extremely efficient and kind of get those barrels to market, and we haven't seen production fall off quite yet. So, and I don't foresee that happening unless we have a move lower in prices.
Yeah, that's the same reports I'm kind of picking up on right now. We're definitely seeing guys reduce in capital expenditure, but the CEOs of these companies, they're backing that up with, we're just getting more efficiency out of these wells. So while we probably will. I mean, if crude gets in the mid 50s or lower 50s, that's just naturally going to knock off a portion of production, at least domestically here in the U.S. Now, do we think that's going to be there's 13.7 million barrels a day of production in the U.S. Okay, we got a lot of room to go down, and it's not going to necessarily, even if that's a 5% drop, that's substantial in oil. So that's really what the big factor is there. I'm with you though. I think with OPEC, we've seen a lot of price action this week that has probably been born because of all these reports that we've seen from Bloomberg and other networks as well that have put that out. So, there's a little bit of a downshift. The government shutdown also probably had a factor, had a move there as well. I ultimately don't think that we're going to, the government shutdown will affect things unless it's a longer term issue. But as of now, we definitely will keep tabs on that. Everything the EIA is saying, though, is they're going to kind of keep. I don't think there's any updated reports on whether or not that's going to affect their reports or anything like that. But we will stay tuned on that and make sure to keep people updated on it through our reports.
Yeah, I think the EIA said as planned, they're going to continue releasing data as planned. So they're still working. So thank you to the EIA for making my job a lot easier and producing more and more data. So
absolutely. All right, I think that's all we got for today. If you guys have any questions for us, please reach out. We have all our information in the show notes. And let us know if you guys what your thoughts are on this energy market. We're going to start doing more polls, seeing if people have a little bit more of their what their thought process is on what this oil market's doing. Because for a long time, the drill baby drill sentiment really drove this market down, and then we seen this summer it kind of pop back up. So the sentiment matters, and we're looking to hear more from you. So,
all right.
Thanks, everybody.
Thanks. Right there, too.
You've been listening to the Focus on Fuels podcast with Trevor McClanahan and Alex Hodes, brought to you by StoneX, NASDAQ ticker SNEX, a global Fortune 100 financial services company with a century of commodities risk management experience. Subscribe to Focus on Fuels on your preferred podcasting platform. For insights on managing fuel and energy price volatility, and to sign up for the free StoneX Morning Energy Brief newsletter, email focusonfuels@stonex.com or visit www.stonex.com. Please feel free to rate, review, and share this episode with colleagues. Until next time.